Hello investors and welcome to Stock AI Insights. Today is February 26, 2026, and here is your high-speed briefing on the market's essential moves. We had a really strange day on Wall Street where the market's AI darling, NVIDIA, posted mind-blowing earnings and then its stock promptly fell off a cliff, dragging the whole tech sector down with it. So, what on earth is going on? Let's get into it.
Just a quick reminder before we dive in. This program is for educational purposes only and does not constitute financial advice.
Okay, here's the game plan for today. We're going to start with the overall market pulse, then really dig into that NVIDIA paradox. After that, we'll check out the day's biggest winners and losers, zoom out to the macro environment, hear what some Wall Street titans are warning about, and finally, get you set up for your week ahead.
First up, let's take the pulse of the market. And if you only looked at the headlines today, you'd miss the real story. It was a classic tale of two completely different markets.
So let's look at the scoreboard. The Nasdaq, which is just packed with all those big tech names, dropped over 1%, and that pulled the S&P 500 down with it. But look at this. The Dow barely moved, and the Russell 2000, which is all about smaller companies, actually had a pretty solid day, up 0.5%. This split tells you everything. Money wasn't really leaving the market, it was just moving around.
And this chart really nails that point home. We saw a very clear rotation of capital. The information technology sector got hammered, down 2%. So where did that money go? Well, a lot of it found a new home in places like financials, which climbed over 1% as investors scrambled for what they see as safer harbors.
Which brings us to the main event, what I'm calling the NVIDIA paradox. We're talking record-shattering earnings, met with a sinking stock price. This is the story everybody is talking about today, and for good reason. So this is the million-dollar question, isn't it? Why in the world did NVIDIA's stock fall 5.5% after reporting what was, by all accounts, just a spectacular, blowout quarter? It just doesn't seem to make sense on the surface.
And let's just put this into perspective for a second. The company's data center revenue, just that one division, hit a staggering $68.13 billion. That's a record. I mean, the growth is just off the charts insane. The demand for their AI chips is completely through the roof.
NVIDIA's own CEO, Jensen Huang, said it best. Customers are racing to invest in AI. The demand is absolutely insatiable. So, if the business is firing on all cylinders like never before, what could possibly have spooked the market?
Well, it turns out it wasn't just one thing, but a whole cocktail of anxieties. You've got lingering uncertainty about their sales to China. Then there's the fact that a huge chunk of their sales go to just a handful of big tech clients. And of course, after a massive run-up like NVIDIA's had, a ton of investors just decided it was time to cash in and take profits. And looming over all of this is the big, scary question, are we in a broader AI bubble? Basically, even a perfect quarter wasn't enough to calm the market's nerves.
Now, the ripples from that NVIDIA drop were felt all across the market. But it wasn't the only story playing out. Let's take a quick look at some of the day's other big movers.
On the winning side, you saw some pretty interesting names pop. The quantum computing firm IonQ just soared, up over 21% on a strong outlook. Meanwhile, good old defensive names like J.M. Smucker got a nice boost. But on the losing side, that AI anxiety was contagious. C3.ai and AMV both fell, kind of in sympathy with NVIDIA. And it was a brutal day for Universal Health, which plunged 11% after missing its earnings targets.
Of course, none of these stocks move in a vacuum. So let's zoom out for a second and look at the macro environment to see what bigger forces were at play today.
The bigger picture was actually pretty interesting. The 10-year Treasury yield fell, which is usually good for stocks because it lowers borrowing costs. And speaking of which, that helps push 30-year mortgage rates below 6% for the first time in years, a great sign for the housing market. At the same time, riskier assets like Bitcoin took a bit of a breather, while consumer confidence actually ticked up, which shows the average person is still hanging in there.
So with that mixed bag of data, what are the big strategists on Wall Street saying? Let's tune in to some expert warnings and check out the overall outlook.
Morgan Stanley's Mike Wilson is pointing to something he calls a stealth correction. What he's saying is, yeah, the big indexes look okay, but if you look under the hood, a whole lot of individual stocks have already, in his words, basically crashed. He notes that the gap between the market's biggest winners and its biggest losers is the widest it's been in 2 decades.
And adding to that cautious tone, you have Jamie Dimon, the CEO of JP Morgan Chase. He recently said his anxiety is high and that he's not comforted by high stock prices at all. In fact, he thinks those high prices just add more risk to the whole system. When a guy like Jamie Dimon says he's worried, Wall Street tends to listen up.
But, and this is a really big but, despite all these short-term warnings, the long-term consensus is still pretty bullish. Mike Wilson, the very same strategist who just warned us about a stealth crash, believes that correction is mostly in the rearview mirror. His firm's base case target for the S&P 500 by the end of the year is 7,800, which suggests there's still a lot of upside from where we are now.
So what could shake things up next? Let's wrap this up with a quick look at your week ahead and the key data you'll want to keep your eye on.
Okay, so tomorrow is a big one. We're getting a key inflation number with the Producer Price Index, the full Consumer Confidence Report, and the minutes from the Federal Reserve's last meeting. That last one is huge because it could give us some major clues about where interest rates are headed.
AI analysts' bottom line. Today's tech sell-off feels like a critical shift. The market seems to be moving away from pure AI hype and starting to focus again on the fundamentals. And what that creates is a market that's both cautious, but also full of new opportunities.
So what do you think? Is this a healthy correction or maybe the start of something bigger? What's your take on today's price action? Let us know down in the comments. Thanks for watching, and I'll see you in the next update.